So now let's study, and I've covered this quite a few times before, the fear index. In this case, the Rvx, which is the Russell 2000 fear index. The Rvx is absolutely a fantastic and invaluable tool for traders to understand the directional bias for the market, particularly the Russell 2000 small cap index. So you look at this chart at face value. I'm staring at one of my screens, and it looks like a frantic EKG snapshot. Cardiac palpitations, right? Heartbeats. That's exactly what it is. This is the fear index, when people start to feel scared and you have those 200-point type of drops in the market from nowhere. This is where the fear index spikes. This is where your heart rate goes up. So, saying all that, let's zoom in. This is the daily chart of the Rvx, and the first thing that you notice, let me get my drawing tool out here, is that we are on the lower end. We did a nice reversal spike, and we are on the lower end of the Bollinger. Now, what happens when we get to the lower end of the Bollinger? Well, I don't need to tell you. You look at it yourself. This is what happens. We get to the lower end of the Bollinger, and we generally spike up. It simply means that the market is ready for a quick pullback to reset the indicators, and I showed you the other side of the picture in my other video cast. Not that hard to understand. So we are right now down here. This is where we were just a couple of days ago, and this was the spike on let me get this out. This was the spike on the 4th of August, being the daily chart, and we've come down all the way there. Basically, it's just doing what it's supposed to do. So let me zoom in a little bit here. Okay, we get towards these extreme spikes during this was April 15th, when we had that big drawdown, the Putin scare and the whole works, the precursor to the Russia-Ukraine tensions, all kinds of stuff. And here we are again. Now this spike went up. You can see this, and I'll show you a closer chart so you can see it more. It went up to 19 in a heartbeat, in a nanosecond, and that was back last Friday when we had that big, sharp, sudden pullback on the fact that Ukraine and Russia were almost going at it. But that wasn't the case. So we pulled back, and this is where we are today. So we still have a little bit of downside to go to kiss the lower Bollinger, which is around 16. We closed at 16.55. But again, it tells us, if you want to be somewhat of an astute trader and not a crazy greedy one, but someone who wants to be consistent with their money making, then you have to keep in mind that generally when things come to lower Bollinger, they'll bounce a bit, and that bounce would basically be to test the back end of this 50-day moving average. That's around 1841 and 1894, call it 19. So keep all those numbers in mind. You can put this on your own screen. Like I always say, look at your own charts too when you're trading. This is what we see on the daily. On the 60-minute. So the 60-minute is telling us that, and this is what the positive divergence I was talking about. Let me get this quickly lined out here. Okay, this to me is very clear. So let me try to see if I can explain this to my traders. This is a positive divergence, because when the VX was at the Rvx was at this level, which is around 1825, the histograms were at their lowest. They were down here. They were at minus 0.3. Now we are, from a price point, just like a stock, on a price point standpoint, we came down and tested 1575, and today we are down here at 1634. But look what's happening to the internals. The internals are rising. So what does it tell you? It tells you that within the next 24 to 48 hours, and it all falls within the framework of what's going to happen this week, I've talked to you, we're going to see a sudden, sharp, volatile spike as this positive divergence plays out itself. Positive divergences or negative divergences do not happen instantaneously. They normally take 24 to 48 hours to play themselves out. Just the nature of the beast. So if you want to look at this, as the case, then we have a slightly downside bias on the RVX. That means the market's going to be slightly stronger going into tomorrow, and then we're going to have some sort of sudden reversal sometime later in the afternoon, if not into Wednesday. I think Wednesday is going to be the day, I think, or even tomorrow afternoon, and that's going to move up the RVX all the way, possibly to complete this pattern, which would be around 1950. Now, if it rises from 1630 to 1950, 3 points in the RVX is basically a pretty sharp pullback in the market, and that equates to, I think, somewhere around the 100 plus type of pullback in the market, which is very, very possible. So this is what somebody was saying, that they couldn't quite understand. They had asked a question on the chat room late this evening, that what was that they couldn't find sure how to identify the positive divergence that Clue mentions. Well, this is the positive divergence that Clue is mentioning. This I see very clearly. There was a so that's really what I'm getting at. Okay, so this could very well, generally speaking, this is almost a given that we're going to see a sharp pullback in the market sometime within the next 24 to 48 hours. And with these levels so dramatically low, the chances of it happening are pretty big, because the lowest level that we reached on the, if you look, we're going to look at a band. 1 second here. It's 15 to 16, and we're almost there. You cannot have moves like this without resets in the market. In other words, the market needs to come down a bit in order to wash out the mini excess that happens on a short-term basis, what I consider to call mini euphoria. So here we are. Okay, it can fall into the box and go to 15. That's very, very possible. It's happened before. But even then, this positive divergence that we clearly see, that started when the RVX was at 18, is going to play out. That's it. Let me take a look at the VIX. Again, the VIX is for... Why does the VIXH keep on coming? VIX. There. Okay. So let's look at chart of the VIX on the daily basis. We can also see that the VIX is heading towards the low range. Is it possible that we go back and test these depths of 10? In that case, I'll go hands down and short and just sit there, because those are pretty dramatic numbers. If you look at the internals, you're going to notice a couple of things here. This is the Bollinger. I put Bollingers over these histograms just to get an idea on the MACD histograms, and we can see we're on we are basically the lower end of the Bollinger. So what does this mean for us? What it means for us is that if we do drop towards 10, well, that's a screaming short on the market. Or we stay here. Let me get the squiggly line. We stay around here, and generally speaking, these are the turning points generally. Okay, look at this. So we are pretty oversold here on the VIX. And then we bounce. Where do we bounce? We bounce towards and try to close this gap that I notice here at around 1560. So roughly about 3 points. Or we get towards about at least 2 points on the VIX. So in that case, that's going to feel pretty dramatic as the market pulls back. Let's take a look at, I just have a minute here on this thing. Let's take a look at the hourly chart. The hourly chart is telling me that it's probably going to be a little bit more down towards 1173. Things get extreme. People think that the market can never go down anymore. I'm sorry, go up. Market can not go down, and boom. So this is again a positive divergence. This was the low of the histograms when the VIX was at 14. We are here. There was a positive divergence. Positive divergence is still building. So I still believe the VIX gets and tests at least 14, and then possibly fail there. If it breaks out over 15, then we're in deep trouble. That means the VIX is going to head back to 17.5. So that's the story, expecting a sharp quick pullback intraday or intra-week, not sure yet. We'll monitor it very closely. Thank you very much for listening. Stay clueless, stay flexible, trade fast, make money.